In a single week, gas prices in Canada jumped 20 cents per liter. Oil spiked from $70 to over 110 per barrel. And the Canadian dollar, instead of strengthening like it used to when oil rises, actually weakened. The Middle East war isn't just a geopolitical crisis. It's hitting your wallet right now, and it's going to get worse before it gets better. But here's a twist. This time, Canada's oil wealth won't protect most Canadians the way it used to. Let me explain exactly what's happening and what it means for your money. Welcome back to KP Money Talks. Today, we're breaking down how the war in the Middle East is driving oil prices through the roof and why, this time, it's different for Canadian consumers. I'm going to explain the mechanics of oil spikes, why Canadian dollar isn't helping like it used to, who wins and loses in Canada, and most importantly, what you can do to protect your finances. Hit that subscribe button and let's get directly into it. Let's start with the basics. Why did the oil prices jump 57% in just 2 weeks? The Strait of Hormuz blockade. Since the US and Israel launched strikes on Iran on February 28th, Iran has effectively blockaded the Strait of Hormuz, a narrow waterway on its southern border. This is the most critical oil choke point in the world. About 20% of the world's crude oil passes through this strait, roughly 15 million barrels per day. Iran's Revolutionary Guard warned shippers away from the area, and most have complied. The net impact is an effective loss of 8 to 10 million barrels per day of crude oil supply globally. Oil prices spike. Benchmark crude oil price in the USA hit a 2-year high, rising above $90 per barrel initially, then spiking near $120 before settling around $110. For context, oil was trading around $70 per barrel before the conflict began. That's a 57% increase in under 2 weeks. Gas prices across Canada have skyrocketed as a result. The national average climbed from 133.4 cents per liter before the conflict to 150 to 154 cents per liter within a week. British Columbia is seeing the highest prices at 168.6 cents per liter. Some stations in Montreal are even posting $1.88 per liter. That's an increase of 15 to 20 cents per liter in 1 week, and experts warn it could go further if the conflict drags on. And here's where it gets interesting. Canada is the world's 4th largest oil producers, and you'd think higher oil prices would be great for us, right? Not anymore. Here's why. Historically, when oil prices spiked, the Canadian dollar strengthened alongside it. This created a natural hedge for Canadian consumers. Yes, gas got more expensive, but your Canadian dollar got stronger, which meant imports, groceries, and everything priced in the US dollar got cheaper. The pain was offset. But that mechanism has weakened dramatically in recent years. Despite oil jumping 57%, the Canadian dollar actually weakened to around 71 cents USD, close to multi-year lows. Why? Safe haven demand for US dollar during geopolitical crisis overwhelms the oil currency link. Investors are fleeing to US dollar and treasury bonds for safety, not Canadian assets. And here's what it means. With the Canadian dollar no longer rising alongside oil, price spikes now translate more directly into higher living costs for Canadians. You're paying global market prices for gas in weak Canadian dollars. That's no currency cushion anymore. For Canada, war-driven oil price spikes are no longer a national windfall. They are redistribution from consumer to energy producers. This oil spike creates massive winners and losers across Canada, split largely by province and sectors. When crude prices rise, Alberta and Saskatchewan collect more royalties, and energy company revenue climb. For that slice of Canada, conflict in the Persian Gulf brings economic benefits. The TSX Energy Index has rallied 15 to 25%. Companies like Suncor, Canadian Natural Resources, and Cenovus are posting record profits. Oil and gas extraction accounts for about 7% of Canada's GDP and supported approximately 446,600 direct and indirect jobs in 2023. But there are limits. Pipeline capacity and production limits means Canadian producers cannot expand quickly when global prices surge. The Trans Mountain Expansion project completed in 2024 helped, but production cannot be scaled overnight. Bottlenecks still burn the swift supply response needed to realize a windfall gain. Alberta and Saskatchewan benefit, but not as much as you might think. For most Canadians, especially those in Ontario, Quebec, and Maritimes, the picture is simpler and less pleasant. Higher oil prices mean higher costs at the pump, in grocery stores, health bills, and basically everything that requires energy. A sustained $10 increase in oil typically raises Canadian inflation by roughly 0.3 to 0.4% points over the following year. With oil up $40, that could add a 1.2 to 1.6% inflation, pushing core inflation from 2.5% back towards 4%. Here's what most people are missing. The gas price spike is just the beginning. The real damage comes from secondary effects. Food price crisis. The fertilizer shock is potentially more devastating than the oil shock itself. The Strait of Hormuz is major artery for urea, ammonia, sulfur, and other fertilizer inputs. Nearly 50% of global urea and sulfur exports transit through that strait. Mike Juan Massow, a professor at the University of Guelph, told CTV News that Canadian farmers are already seeing a significant impact on the price of nitrogen fertilizers, much of which is produced in the Middle East. Urea prices have increased by about 30% over the past month. That is particularly brutal timing. Northern Hemisphere spring planting is beginning right now. Farmers across Canada are burning fuel to get seed in the ground, and that fuel is now 15 to 20 cents per liter more expensive. Plus, fertilizers costs are spiking. The result? Expect food prices to climb significantly over the next 6 to 12 months as these input costs flow to grocery stores, transport, and everything else. Higher diesel prices affect commercial truck, trains, and ships. Every product that moves across Canada gets more expensive. Gas analyst Dan McTugg. Even if you don't drive a car, even if you drive an EV, you're going to feel it. It's going to impact the cost of pretty much everything, including the building of those EVs. The Bank of Canada had just cut rates to 2.25% and was signaling it was done cutting. Now, with inflation threatening to spike again, rate cuts are completely off the table. In fact, if inflation climbs back above 3.5%, the BOC might be forced to hike rates again, devastating for mortgage holders renewing in 2026 at already elevated rates. So what can you actually do about all this? Here are practical steps. Number 1. Budget for sustained high gas prices. Experts say even if the conflict ends soon, prices tend to remain elevated for months after. Warren Mabee from Queen's University expects gas prices to stay 5 to 10% higher than pre-conflict levels even after fighting stops. Build this into your budget. If you're commuting, consider carpooling, transit, or negotiating remote work days. Number 2. Consider electric or hybrid vehicles. The spike has boosted interest in EVs. Federal EV rebates returned last month, and Quebec is debating gas price rebates. If you drive tens of thousands of kilometers per year, the math on EVs is getting more compelling by the day. Number 3. Stock up on non-perishable now. Food prices are going to climb as fertilizers and transportation costs hit grocery stores over the next 3 to 6 months. If you have storage space, stock up on non-perishable staples now before prices rise further. Number 4. Adjust your investment portfolio. If you're not already exposed to Canadian energy stocks, consider a small allocation to hedge against further oil spikes. Energy stocks are up 15 to 25%, but could go higher if the war drags on. Gold has also surged past $2,800 per ounce as safe haven. Consider holding some gold exposure. 5. Lock in fixed mortgage rates. If you have variable rate mortgage or a new renewing soon, strongly consider locking in a fixed rate. If inflation spikes and the Bank of Canada hikes, variable rates could climb quickly. Number 6. Hold extra cash. Keep 1 to 2 months of extra expenses in a high interest savings account earning 4% plus. Uncertainty requires liquidity. The bottom line is that the war in the Middle East is driving oil prices up 57%, gas prices up 15 to 20 cents per liter, and threatening to push food prices significantly higher over the next 6 to 12 months. Unlike past oil shocks, the weak Canadian dollar means you're absorbing the full impact without the currency cushion that used to help. Alberta wins, most Canadians lose, and the ripple effect are just beginning. If this video helped you understand what's really happening, hit that like button and subscribe for Canadian economic analysis. Comment below and I'll read it. Stay informed, stay prepared, and I'll see you in the next one.